Warren Buffett. How to find great stocks for 2023. Okay, so you've seen that the market's down at the moment, and it's a great opportunity for investing right now. But how on earth do you actually find great stocks to invest in? Well, in this video, we're going to talk about a surprisingly simple screening method inspired by super investors such as Warren Buffett, Peter Lynch, Charlie Munger, and Manash that would help you find amongst the thousands of publicly traded businesses out there. So, there's 6 steps to this process. And with that, let's start with step number 1. Now, a lot of people think that the first step to finding a great business is to simply find what stocks are the cheapest, like what has the lowest PE ratio, and what does the stock screener spit out at you as the cheapest result. Now, that approach is definitely wrong, and this habit of looking at the price is a very dangerous habit to start with. If you want to do well in the long run, the real first step in the screening process is, in fact, to define your circle of competence. So, how do you do that? Now, suppose that you're not great at video games, but you do spend a good chunk of your time playing them, and you certainly spend way too much money on them. So, video game companies are probably going to be much closer to your circle of confidence than, say, pharmaceutical companies. So look for those common themes of your interest, and then from there, you can literally Google search video game stocks. Now, chances are, if you spend money on it, if you spend your time on it, and if you're naturally good at it, then you'll already have a good idea of how businesses in that field operate. Now, Warren Buffett puts it like this: you can't know about a business enough in a month or 2 months. You have to develop understanding and knowing of what you do understand and don't understand, and that's the key. It's not important how big the circle is. The important thing is staying inside the circle, and if that circle has only got 30 companies in it out of thousands on the big board, as long as you know which circle they are, you're okay, and you should know those businesses well enough so that you don't need to do lots of work. So step 1 is to define your circle of confidence. Don't just try and find a stock that's super cheap and then try and work backwards to understand it. Now, what do you do after you've found a selection of companies that you feel as though you could understand? Well, for the next step, we're going to consider the viewpoint of Warren Buffett disciple Monish Pabra, who says that his most preferred starting point on a company to see, and the first thing he's looking for, is who are the shareholders. Because it could be someone he admires, and they have this particular company as a holding. So lucky for us, there's no anti-plagiarism rules in investing. So the next step is to then take your list of companies and see that if any one of the super investors own them. The Buffetts, the Mungers, the Lilus of the world. So there are 2 ways to go about this step. You can either look at the super investors' portfolios and see what's in there, or you can look at the company you're interested in and see if any super investors are on the list of major shareholders. For example, if you take Berkshire Hathaway, you'll find that Warren Buffett's largest holding is Apple, Bank of America, and Coca-Cola. You can literally just browse all of these super investors' portfolios, and then, if you find that one of the investors holds your stock, just research their rationale for buying it. You know Warren Buffett's spoken many times in the past on Apple and Coca-Cola. A quick Google search will tell you literally everything about his thesis. So that's the first method, or alternatively, you can simply search the company of interest, say Apple, and then you can just look at the ownership tab. Now, yes, there's going to be a flood of ETF providers and investment banks on the list, but occasionally you can find super investors as well. Now, step number 2 is to use the ticker to your advantage and check whether your companies have been bought by the world's best investors. Then, just Google what they've said about the company in the past. to begin to get an understanding of what the value investing thesis actually is. Step number 3 is to go and skim through the most recent annual report. Now at this stage, you don't need to read the whole thing because there's some manual reports that can be very long and very intimidating. But at the start of every single annual report, also known as the 10K, the management will perfectly describe what the business is, what they do, and how they make money. You know, if you take 5 minutes and just read that section, you'll very quickly get a sense of whether this is something you're interested in or whether this business goes on the too hard pile. Simply type in your company's name, Meta, for example. Then you can go down to filings, narrow it down to the 10Ks, and there you go. And if we go to Meta's most recent annual report, you can very quickly get a sense of what they're all about. You know, the first section tells us that Meta's a family of 4 apps, and they generate all of their revenue from selling ads. They have their Reality Labs business, which is a collection of virtual and augmented reality projects, but that's still a very small part of their business. It really is that simple. That's all you need to do in the screening stage. Just get a sense of how the business works and whether you want to learn more about it. Now getting back to Monish, who also suggests to go through the letters to shareholders of the past 2 to 3 decades to see what they were saying versus how the trajectory of the business has gone subsequently. So, step 4 is to read the annual shareholder letters over time. Why? Well, because it shows you a lot about the management's execution and it tells you how they treat their shareholders. You can tell a lot about a CEO from the contents of the shareholder letter. So go back a few years, read what they were promising, and then cross-check that with how well they actually did. Do they under-promise and over-deliver? Are they honest? Do they talk about the challenges as well as the successes, or are they always trying to sell you this company? Are they just trying to convince you how good the company is? The other interesting thing about reading these letters is especially reading them in the past, which tells you how resilient the business model is, and you can judge a lot. Now again, this step is as easy as a Google search. Netflix letter to shareholders, Amazon shareholder letters, or Berkshire Hathaway. Now it's worth noting that not all companies will do this, which is a bit of a bummer, but you know, a lot of the good companies still do. However, if they don't, well, don't fear, because there's actually a backup plan, which is the 5th step. So in the same vein as reading the shareholder letters, the earnings calls also give us a really good sense of what the management is like. Now, listening to the earnings calls is an important habit to form because it helps you judge the 2 main characteristics of company management, which is skill and integrity. If they have skill and integrity, then in the earnings calls they won't overpromise, but they definitely will deliver. So the final step is to check out the proxies, aka the Death 14A form. This is the document that actually explains how the management team are compensated. What do they have to do to earn their bonuses? How much stock do they own or get given, etc. And this is another crucial step because you want the management's incentives to align with the long-term shareholders. You want modest salaries and bonuses related to long-term success of the business and long-term success of their shareholders. And furthermore, you want the CEO to have a decent stake in the business so that their wealth is directly tied to how well they can grow that company. Ultimately, if the CEO gets a big fat salary and has no stake in the company and their compensation doesn't really change based on how well the business or the shareholders do, that's when you need to run. So that's the last step in the process. And finally, if we pass all of those checkboxes, we can then start to dig into the financials, the valuation, etc. overall, guys. That's the easy process that you can use to kind of find high-quality businesses relatively quickly. You know, in the space of a couple of hours, you've got a good idea of 3 out of the 4 pillars of the Warren Buffett approach. You'll understand the business because you know it's in your circle of competence and you've done the reading. You'll understand the moat from reading what other investors like Warren Buffett, etc. think about the business. You'll have checked the management team through the shareholder letters and the earnings calls and the proxies. And then the last thing to do is to properly go deep into the business. Analyze the expected future growth, check out the financial statements, and then come up with your own valuation. Thank you so much for watching this video. Leave a like on it if you enjoyed it. Subscribe for more videos, and we'll see you guys soon.